Stock markets are at all-time highs again, so this week we're going to focus in on the UK. Good morning everyone and welcome back to your week ahead. It's very much a focus for the UK this week, given we have inflation data and jobs data over the next 5 days. The backdrop, of course, though, is that despite difficult geopolitical situation across Europe, stock markets in Germany, France, Italy, Spain, the UK, and now the Nasdaq in the US are all at or close to all-time highs. And it seems certain that the S&P 500 will reach a new high in just a matter of days. So what's driving that is global profits optimism. Global profitability across corporates is enhanced by robust savings and fiscal deficits. So let's turn to the UK. Well, this week we begin with the jobs data for the month of December for the survey data, but for payrolls data, which is measured by HMRC, it's January. And this is where grey clouds might gather for both government and for our central bank, the Bank of England. The survey data is statistically useless because the response rate from British businesses has fallen from around about 50% in 2013 to now less than 15%. That is, only about 1/7 of companies surveyed are actually responding to indicate how they intend to alter or modify their hiring intentions over the weeks and months ahead. So we must rely more and more on the HMRC payrolls data, and this is where there is some darkness in the data. The first 6 months of last year showed robust hiring. Everything changed when Labour were elected, and we started to see some negative prints, that is actual job losses coming through from HMRC. In fact, the data turned aggressively negative in both November and December, and this seems to be a direct reaction to the budget announcement at the end of October, where there were almost 70,000 jobs lost in those 2 months alone, and that took payrolls growth for the entire 2024 negative. So the HMRC data does indicate that there were net job losses through 2024, and that's one of the reasons why the Bank of England are turning more dovish on the outlook for monetary policy. They realise that if jobs growth continues to be negative, then we're likely to see continuing rise in unemployment. And that's what the analyst consensus is for tomorrow. That is a further increase in unemployment, and that would take us to the highest level since May 2017, excluding the COVID period when we had the pandemic shock. So this could be very difficult for the central bank because of the inflation data which follows on Wednesday. It is expected that headline inflation will rise to 2.8% from 2.5%. And this is directly influenced by wholesale energy prices, which aren't influenced by monetary policy. There's not much the central bank here can do to influence energy prices globally, which are priced in dollar terms. The most difficult thing for the Bank of England, though, is going to be the expected rise in core inflation, which is expected to rise towards 3.8%. Now, this is difficult because core inflation isn't affected by energy prices or food prices. It's really driven by domestic services growth. And that will be reflected, of course, in wages as well this week, which are expected to rise again towards close to 6%. So the conundrum is we have weakening job growth, rising unemployment, very strong wages and rising inflation. And this means there could be some dark clouds for our Chancellor here towards the next budget update next month, but also really binds the hands from the Bank of England for doing more with interest rates. It's quite clear they would like to cut rates more and possibly be as low as they are in the European Central Bank, which is towards 3%. Recall that they're still around about 4.5% here in the UK. So any surprise in the data will be taken well by markets because sentiment here is so poor, but it does seem that we're likely set for some further periods of difficult jobs data in the UK. So that's all for today, but please join us tomorrow where we'll update you on the first data release. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.